Welcome to the deep dive. Today we're tackling a really fascinating company, one you probably haven't spent much time thinking about, but maybe you should. ASML.
That's right, the Dutch giant. They don't actually make the chips, in your phone or computer.
True.
But they build the absolutely essential machines needed to make all the advanced ones. Literally indispensable.
Exactly. If you want cutting-edge AI, the latest phone, that chip went through an ASML machine somewhere along the line.
For sure. And our sources today, we've got a detailed financial research report, a risk analysis, a full 10-year financial breakdown. They let us do one key thing.
Which is?
Apply those classic strict value investing rules. Think Warren Buffett style. We want to see if ASML is both a great company and if it's selling at a great price.
That's the classic tension, isn't it? Quality often comes with a hefty price tag.
Always the challenge.
So before we jump into the numbers, just the usual quick reminder for everyone listening. This is purely for educational discussion. We're analyzing the source materials we have, but this isn't financial advice in any way. Always do your own research. Maybe talk to a professional.
Absolutely. Okay, so first things first. Why ASML? Why indispensable?
Yeah, what's the secret sauce?
It really comes down to one technology. Extreme ultraviolet lithography. EUV.
EUV, right. And they are the only supplier globally.
The only one. If you want to make chips below, say, 7 nanometers, the really advanced stuff, you have to use their machines. There's no alternative.
That sounds like a textbook definition of a technological monopoly. How do they even build that?
Well, it wasn't overnight. It was decades of, honestly, really expensive R&D, lots of trial and error.
I bet.
Our sources mention something like 6 billion euros spent just to get EUV working properly.
6 billion just on development.
Just on development. A 20-year marathon, not a sprint. And that built this technological moat that seems almost impossible for anyone else to cross right now.
Okay, so a massive R&D effort created the monopoly. How does that translate into, the actual business model, the financials?
It creates some really strong and kind of predictable revenue streams.
Okay.
The report breaks it down. About 77% comes from selling the brand new lithography systems, the big ticket items.
Right, the $150 million machine.
Exactly. But the other 23% is also really important. It's what they call installed base management.
Installed base. So servicing the machines already out there.
Precisely. Services, software upgrades, spare parts, maintenance, contracts. It's very stable, almost recurring revenue. That part alone was about $6.5 billion in 2024.
Wow, $6.5 billion just from services. That sounds like a great buffer against the usual chip industry cycle.
It really is. It provides stability. But let's talk customers. Who's buying these incredibly expensive machines?
It has to be a short list, right?
Very short. You're talking about the giants. TSMC, Samsung, Intel. A handful of players drive the vast majority of the orders.
This high customer concentration, is that a risk?
It can be, but here's the thing. Those customers need ASML. They have no other options for EUV if they want to keep making faster, smaller chips.
They have to buy from ASML.
No.
And keep paying for the service.
They're locked in. The cost for a competitor to even try and catch up, we're talking tens of billions, many, many years of development. Maybe they never even get there. The moat is just that strong.
Okay, ironclad moat seems fair. Let's pivot to the financials then. The great company test.
Right.
The 10-year analysis in our sources. Some of these numbers are just, incredible.
They really are top tier. Let's start with gross margin. Consistently high.
How high?
Generally between 44% and nearly 53% over the last decade.
Yeah.
The latest quarter, Q3 2025, was 51.6%.
And the benchmark for quality is usually around 40%.
Yeah. For a quality company, value investors often look for 40%. ASML consistently clears 50%. That just screams pricing power. It means over half of every euro of revenue after the direct costs of making the machine is gross profit.
Incredible efficiency. And does that flow down to the bottom line? Net profit?
It absolutely does. Net profit margin, again, consistently high, usually between 21% and over 31%. Easily clears the typical 20% quality threshold.
Okay. Strong margins? What about cash flow? That's key for value investors.
Yes. Free cash flow, FCF. Using that as our proxy for owners' earnings, it's been positive every single year for the last 10 years.
Every year, even through downturns.
Every year. And not just positive, but averaging, around 25 to 30% of revenue.
Wait, 25-30% of revenue converting straight to free cash flow? In a manufacturing business like this?
Exactly. It's extraordinary. The minimum threshold quality investors look for is maybe 5%. ASML blows that away.
So where does all that cash go?
Well, it fuels fantastic returns on capital. Their return on invested capital, ROIC, is consistently above 20%, often way higher. And return on equity, ROE, even as their equity base grows, has been normalizing around a very healthy 40%.
So they're not just profitable, they're extremely efficient at using capital to generate more profit.
Masters of capital deployment. And you add to that a really strong balance sheet, very conservative debt levels, huge interest coverage.
Okay. So the great company test.
Passed. With flying colors, really. On quality metrics, it's A+.
Right. But quality often assumes things stay stable. What about risks? You mentioned the geopolitical angle earlier.
Yes, that's the big one right now. The near-term headwinds are definitely geopolitical.
So how did the latest results look? Q3 2025.
Pretty solid, actually. Net sales were stable, around $7.5 billion, and new bookings, which tells you about future demand, were really strong, $5.4 billion, more than double the previous year.
So the pipeline looks good.
Yeah, and management is still guiding for about 15% sales growth for the full year 2025. So near term looks okay.
But there's a but, isn't there?
There's a but, and it's a big one, particularly concerning China. Management explicitly warned about 2026.
What's the warning?
China was a huge chunk of sales recently, something like 46% in 2024.
Wow, nearly half.
But they expect that number to drop significantly, both the percentage and the absolute amount going to China in 2026.
Why the drop? Export controls.
That's the main driver, tightening export controls from the U.S. and Netherlands, plus maybe some demand pull-in happened earlier, sort of a normalization. But yeah, it's a major headwind, losing a big chunk of that China business.
That sounds like it could derail the growth story quite a bit.
It definitely creates a challenge, a growth gap. But management tried to put it in context.
How so?
They said even with the China drop, they expect total revenue in 2026 to be at least flat compared to 2025.
Flat? How? Where does the replacement demand come from?
Other regions, think Taiwan, South Korea, the U.S., places heavily investing in AI infrastructure, advanced logic chips. The underlying demand for cutting-edge chips isn't going away.
It's just shifting geographically because of the restrictions.
Exactly. The end market pool seems incredibly strong.
Okay, so geopolitical risk is managed, maybe. What about the really long-term existential stuff? Could someone invent a totally new way to make chips?
That's always the background risk. Technological disruption. You hear about things like electron beam direct write, maybe quantum computing eventually, things that could, in theory, replace optical lithography.
But are any of those close?
Not really, not at the scale and cost effectiveness needed for mass production. And ASML isn't sitting still either.
What are they doing?
They're pushing the boundaries themselves, developing the next generation high-NA EUV for chips below 2 nanometers. That keeps optical lithography relevant for the foreseeable future. Plus, they're moving into adjacent areas like advanced packaging lithography.
So trying to stay ahead of the curve.
Definitely. The leadership seems secure for now.
Okay. Let's pull this all together then. We've got ASML is a truly great company, phenomenal business, ironclad moat, fantastic returns.
Check.
Now for the tough part, that second test. Great price. How does ASML stack up against traditional, strict value investing price metrics?
Well, this is where the story gets complicated, or maybe simple, depending on your view.
How so?
It fails spectacularly on traditional metrics.
Fails. Like what?
Take the price-to-earnings ratio, PE. Classic value investors often look for 15x earnings or less. ASML currently trades around 41 times trailing earnings.
41. Okay, not even close to 15.
Not even in the same ballpark. And it's basically never traded consistently near 15x in the last 10 years.
What about price to book, another classic?
Same story. The traditional threshold might be 1.5x book value. ASML is currently around 10.8x.
Wow. Okay, so PE and PV are way off. Why are those metrics, 15x PE, 1.5x PB, even used? What do they signify?
They generally come from valuing more mature, stable, maybe slower-growing industrial companies, where growth expectations are modest. A 15x PE suggests the market isn't pricing in massive future growth.
And ASML at 41x PE.
The market is screaming that it expects huge continued growth. It's pricing in the monopoly, the tech leadership, the future of AI, not just its past earnings.
So the traditional metrics might not fit this kind of company.
That's the debate. Even on earnings consistency, another value check, ASML stumbled slightly.
I thought earnings growth was strong.
The long-term trend is fantastic, yes. About 21% compound annual growth in EPS over the decade. But it wasn't perfectly smooth. There were minor dips. Flat in 2019, a small dip, like 4.4% in 2022, mostly due to investment cycles or R&D timing.
So not rising every single year, which is the really strict rule some apply.
Exactly. For a purist, that tiny bit of volatility is a technical fail on that specific rule.
Okay, so the simple metrics fail. What about a more sophisticated valuation, like discounted cash flow? Does that make it look cheaper?
Well, the DCF analysis highlights just how sensitive the valuation is to your growth assumptions. The current stock price is around $985 per share, give or take.
Right.
If you plug in a really conservative growth rate for free cash flow, say, it stalls out at only 5% per year.
Which seems unlikely given the demand, but okay.
Right, as a stress test. The DCF spits out an intrinsic value of only about $403 per share.
Meaning hugely overvalued if growth disappoints badly.
Massively. But now, let's use our nominal or sort of base case assumption from the analysis. 15% FCF growth per year. Pretty strong, reflecting the AI boom.
What value does that give?
Around $850 per share.
Still below the current $985 market price.
Correct. Even with robust 15% growth baked in, the analysis suggests it's still maybe 16% overpriced. No margin of safety there for a value buyer.
So what growth rate does justify the current price?
You need to assume even higher growth. If you plug in a really optimistic 25% FCF growth,
Which would be phenomenal sustained growth.
yeah, then the value jumps to about under $755 per share. So the current market price, around $985, it's essentially baking in sustained FCF growth in the high teens, maybe 17–18% per year for the next decade.
So the market is pricing in continued dominance and strong growth. It understands the quality, it's just demanding a premium for it.
Precisely. It reflects the confidence in ASML's unique position. And you have to remember management's role here, too.
How so?
The leadership, folks like the new CEO, Christophe Fouquet, the CFO, Roger Dassin, they have a proven track record. They keep investing heavily in R&D, that $4.6 billion in 2024, to maintain the lead.
And returning cash.
And returning cash. Big dividends, $6.40 for 2023, and massive share buyback programs. There's a $12 billion authorization running now. They're reinvesting for growth and returning capital. Very shareholder aligned.
Okay, so wrapping this all up, what's the key takeaway for you, the listener?
Well, ASML is, without doubt, an absolutely phenomenal business. It nails the great company criteria. The moat is real. The returns are world-class. But it consistently trades at a very rich valuation. It just fails the strict price discipline of a traditional value investing approach. Always looks expensive on paper.
So it forces a choice.
It really does.
Yeah.
Do you stick rigidly to your price rules, maybe looking for that 15x PE, and potentially miss out on what could be decades of compounding from a unique monopoly? Or do you decide that this level of quality, this kind of locked-in growth trajectory in a critical industry, justifies paying that premium, that maybe the traditional rules don't fully capture this specific situation?
Which leads us perfectly to our final provocative thought for you to consider. ASML's next-generation machines, the high-NA EUV, they're essential for pushing chips below 2 nanometers. That's the future of AI, advanced computing, everything.
The absolute cutting edge.
So if that demand truly explodes, if AI requires computing power, we can barely imagine today. Will the investors who waited, who insisted on buying ASML only if it hit some arbitrary low PE ratio, will they look back and realize they missed out on one of the truly great compounding machines of our era? Does extreme quality, in rare cases like this, actually make the traditional concept of a fair price almost irrelevant?
Something to definitely think about.
Indeed. And if you found this deep dive interesting and want to hear more analysis like this, definitely subscribe to our channel, Deep Value Investing, on Apple Podcasts or Spotify.
We'll be back soon with another one.
Until next time.